Imagine having the power to grow your wealth, even if your bank account isn't overflowing. What if there's a way to step into the world of investing without needing a fortune? Many believe that investing is reserved for the wealthy, but that's a myth waiting to be shattered. Picture this: a beginner, armed with just a few dollars, stepping into the stock market and making savvy choices that could change their financial future. This isn't just a dream, it's a reality that anyone can achieve. But how exactly do they get started? What are the best strategies to maximize every single dollar? As we dive deeper, the landscape of micro-investing, fractional shares, and innovative platforms will unfold, revealing opportunities that may seem hidden at first glance. Stay with us as we explore the essential tools and tips that empower even the most novice investors. Each step taken today could lead to significant growth tomorrow. So how do you transform your small savings into a powerful investment strategy? And what key insights can unlock the doors to financial freedom? The answers are just around the corner, ready to reshape your understanding of wealth building. Let's dive in. Investing doesn't have to break the bank. One of the best low-cost options available today is fractional shares, which allow investors to buy a portion of a share rather than the whole thing. This means that even if a company's stock is priced at $1,000, you can still invest as little as $10 and own a fraction of that share. This opens up opportunities for those who may not have large amounts of capital to invest, but still want to participate in the stock market. Exchange-traded funds, ETFs, are another excellent low-cost investment option. These funds are a collection of stocks, bonds, or other securities that are traded on an exchange, just like individual stocks. Because they are diversified, they reduce the risk compared to investing in single stocks. Plus, many ETFs have low expense ratios, making them affordable for investors. They provide a way to gain exposure to a broad market without the high fees associated with actively managed funds. Crowdfunding and collective investment platforms have emerged as innovative ways to invest with lower amounts. These platforms allow individuals to pool their money together to invest in startups or real estate projects. Investors can often start with as little as $100. This democratizes investment opportunities, enabling people to support new ideas while potentially earning a return on their investments. Furthermore, these crowdfunding platforms often focus on projects that align with individual investors' interests or values. For example, someone passionate about renewable energy can invest in green startups. This personalization makes investing more engaging and purposeful, as individuals can feel a connection to the projects they are funding. Lastly, it's important to research and understand the platform you choose for crowdfunding. While the potential returns can be enticing, there are also risks involved, including the possibility of losing your investment. Thus, due diligence is crucial to ensure that you are investing in a reputable project that aligns with your financial goals. Investing in low nominal value fixed income securities can be an accessible way for individuals to enter the world of investing without requiring a large initial capital. These securities often include savings bonds or treasury bills, which can be purchased at a fraction of the cost of traditional bonds. This makes them particularly appealing for novice investors who may feel intimidated by the complexities of the stock market. The main advantage of fixed income securities is the predictable returns they offer. Investors receive interest payments at regular intervals, which can provide a sense of financial security. Furthermore, because these instruments are generally considered low risk, they can serve as a stable foundation for an investment portfolio, giving investors a chance to grow their wealth gradually. Another important aspect to consider is the inflation risk associated with fixed income investments. While they are safer than stocks, the returns may not always keep pace with inflation. Therefore, it is essential for investors to evaluate how these securities will fit into their overall financial strategy, considering their long-term goals and risk tolerance. Additionally, low nominal value fixed income securities can be an excellent introduction to understanding how interest rates work. As rates fluctuate, the market value of these securities will also change, providing a practical lesson in market dynamics for new investors. This knowledge is crucial as they expand into more complex investment vehicles. Lastly, investors can use low nominal value fixed income securities to develop a habit of regular investing. By starting with smaller amounts, they can gradually increase their investment as they become more comfortable and knowledgeable about the financial landscape. One effective strategy for investing small amounts is dollar cost averaging. This approach involves consistently investing a fixed sum of money at regular intervals, regardless of market conditions. By doing so, investors can reduce the impact of market volatility on their overall investment portfolio. This strategy allows them to buy more shares when prices are low and fewer shares when prices are high, effectively averaging out the cost over time. Dollar cost averaging is particularly beneficial for beginner investors who might be uncertain about when to enter the market. This method removes the emotional element of investing, as it encourages a disciplined approach. Investors can set a budget and stick to it, which helps them build confidence in their investment decisions. Moreover, this strategy can be easily implemented with various investment vehicles including mutual funds and exchange-traded funds, ETFs. These funds often have the added benefit of diversification, helping to spread risk across different assets. Therefore, using dollar cost averaging in conjunction with diversified funds can enhance the potential for long-term growth. Investors should also consider their investment horizon when employing this strategy. Dollar cost averaging is most effective over a longer time frame, allowing the effects of compounding to work in their favor. As they continue to invest regularly, they can potentially see significant growth in their portfolio over the years. Lastly, it's important for investors to regularly assess their investment strategy and make adjustments as needed. While dollar cost averaging is a solid foundational strategy, staying informed about market trends and personal financial goals is key to long-term success. Diversification is a critical principle in investment strategy, particularly for those starting with small amounts of capital. By spreading investments across a variety of asset classes including stocks, bonds, and real estate, investors can minimize risk. A well-diversified portfolio is less likely to experience significant losses, as the performance of individual investments can offset one another. When constructing a balanced portfolio, it is essential to consider individual risk tolerance and investment goals. Younger investors may opt for a more aggressive approach, allocating a higher percentage to equities, while those closer to retirement may prefer a more conservative allocation with a focus on fixed income securities. Understanding one's financial situation is crucial for determining the right balance. Investors can also achieve diversification by investing in mutual funds or ETFs, which inherently contain a mix of different assets. This allows even those with limited funds to access a broad range of investments without having to buy each one individually. Such funds are managed by professionals who make decisions based on market research, further alleviating the burden on individual investors. In addition to asset classes, geographic diversification can also enhance a portfolio. Investing in international markets can provide exposure to different economic conditions and growth opportunities. This global approach can help mitigate risks associated with domestic market downturns. Lastly, regular rebalancing of the portfolio is necessary to maintain the desired level of diversification. As some investments grow faster than others, it may become necessary to adjust allocations periodically. This proactive management ensures that the portfolio stays aligned with the investor's overall financial strategy and risk tolerance. Reinvesting dividends and interest can be a powerful strategy for those investing small amounts. When you receive dividends from stocks or interest from bonds, instead of cashing them out, consider reinvesting them back into your portfolio. This approach allows your investment to grow exponentially over time due to the power of compounding. For instance, if you receive a dividend payment and reinvest it into more shares, you'll benefit from additional dividends in the future, thus creating a snowball effect. Moreover, many brokerage firms and investment platforms offer automatic reinvestment programs. These programs enable you to automatically reinvest dividends without having to make manual trades. This not only saves time but also ensures that your investment remains on an upward trajectory. By consistently reinvesting, even small dividends can accumulate into substantial amounts over the years, particularly if you maintain a long-term investment horizon. It's essential to choose the right investments that provide dividends or interest payments. Look for companies with a strong history of dividend payments and the potential for growth. Additionally, consider dividend reinvestment plans, DRIPs, that allow you to buy shares directly from the company, often at a discount. This can be particularly beneficial for small investors aiming to maximize their returns. Investors should also be mindful of their overall investment strategy when considering reinvestment. While reinvesting can enhance growth, it may reduce liquidity since the funds are tied up in additional shares. Thus, it's crucial to balance between reinvestment and having cash available for emergencies or new investment opportunities. Lastly, keep track of your reinvested dividends and interest for tax purposes. While reinvested amounts can increase your overall investment value, they may also have tax implications in the year they are received. Understanding these implications can help you make informed decisions about your investment strategy. Understanding the financial market is paramount for anyone looking to invest, especially with smaller sums. Knowledge equips investors with the tools needed to make informed decisions, which is crucial in navigating the sometimes volatile market landscape. The more you learn about market trends, economic indicators, and investment vehicles, the better prepared you are to optimize your investment outcomes. Investors should take the time to educate themselves on various asset classes such as stocks, bonds, and mutual funds. Each class has its own risk and return profile, and understanding these can help you align your investments with your financial goals. For example, knowing the historical performance of certain sectors can guide you in diversifying your portfolio effectively. Additionally, awareness of market cycles, bull and bear markets, can aid in timing your investments. While it's impossible to predict market movements with complete accuracy, understanding past trends can help investors make educated guesses about future performance. This knowledge can be beneficial when deciding when to enter or exit positions. Investors can enhance their understanding through various resources, including books, online courses, and financial news platforms. Many online investment communities and forums provide a wealth of information, allowing investors to learn from each other's experiences. Engaging with these resources fosters a deeper understanding of market dynamics and investment strategies. Lastly, continuous learning is essential in finance. The financial landscape is constantly evolving, so staying updated on new regulations, investment products, and market trends will ensure that you remain a savvy investor. Regularly reviewing your knowledge and seeking new information can help you adapt your investment strategy as needed. Evaluating and managing risks is a critical aspect of successful investing, particularly for those with limited funds. Understanding the various types of risks, such as market risk, credit risk, and liquidity risk, enables investors to make more informed decisions. Each investment carries inherent risks, and recognizing these can help you prepare for potential downturns. One effective way to manage risk is through diversification. By spreading investments across different asset classes, sectors, or geographic regions, you can reduce the impact of a poor-performing investment on your overall portfolio. This approach ensures that even if one investment suffers, others may offset the losses, thus providing a level of stability. Another key strategy for risk management is setting realistic expectations for returns. Understanding that higher potential returns often come with increased risks can help you align your investment choices with your risk tolerance. It's essential to assess your financial situation and define your risk appetite before making investment decisions. Investors should also consider implementing stop-loss orders or limits on their trades. These tools can help protect against significant losses by automatically selling an asset when it reaches a certain price. While no strategy can eliminate risk entirely, these measures can assist in maintaining a balanced approach to investing. Lastly, regularly reviewing and rebalancing your portfolio is crucial for effective risk management. As market conditions change, so may the risk profile of your investments. Periodic assessments can help ensure that your portfolio remains aligned with your investment goals and risk tolerance, allowing you to make adjustments as necessary. As we wrap up our journey through the world of investing with little money, it's crucial to remember that every great investor started somewhere. You don't need a fortune to begin, you just need the right mindset and a strategic approach. Think about your financial goals. What do you want to achieve? Is it a steady income, building wealth for the future, or perhaps saving for a dream purchase? Now reflect on the tools we've discussed. From fractional shares to ETFs, each option offers a unique opportunity to grow your investment without breaking the bank. But here's the kicker. Are you ready to take the next step? What action will you take today to kickstart your investment journey? And don't forget, consistency is key. Regularly contributing even small amounts can lead to significant growth over time. So, what's stopping you? Before you go, let's ignite your curiosity. How will you diversify your portfolio? Which stocks or funds caught your eye? Share your thoughts in the comments below. Your journey is just beginning, and the financial world is full of possibilities, so stay curious, keep learning, and remember, the best time to invest was yesterday, the second best time is now.